The stock market is down almost 20% from its all-time high just 5 months ago. This has led some commentators to say that we've officially entered a bear market. And if that's true, it's likely that things will only continue to get worse. Meanwhile, crypto markets are imploding, with Bitcoin falling below $30,000 and Coinbase losing nearly 90% of its stock value since its IPO in 2021. On top of that, house prices are looking like they could be on the way down, while inflation remains at 40-year highs. Now, I don't know about you, but my head feels like this giant balloon that's about to explode anytime I try to process everything that's going on at the moment. But regardless, today we're going to talk about why the everything bubble has just popped. Don't forget to leave a like and subscribe, and let's get started. So starting with the stock market, why is it that the likes of the NASDAQ, a stock market index dominated by technology stocks, is down almost 30% since the beginning of the year? I mean, in just under 2 years, from March 2020 to its all-time high, the NASDAQ had returned 130% to investors. Things were looking great for tech stocks. Thematic ETFs focused on technology stocks like Cathie Wood's ARK Innovation ETF had returned over 300% to investors in less than 12 months. But we don't talk about where ARK ETFs are today. But for real, how could things have gotten so bad? The answer is quite simple. Valuations matter. Much of 2020 and 2021 in the stock market was dominated by this ideology that stocks only go up. And for a period of time, it certainly looked that way. The GameStop fiasco literally redefined what was possible in the stock market. Hedge funds were losing billions, while average investors around the world were making huge gains off of a company that wasn't making any money. Special purpose acquisition companies, or SPACs, which are effectively cash grabs, were appearing in their droves to take advantage of all this money pouring into the stock market. A-list celebrities all of a sudden had SPACs, nearly all of which lost money for investors. And now you've the likes of Goldman Sachs separating themselves entirely from the SPACs they were previously involved in. But even the wider market was totally off the rails. The S&P 500 as a whole still has a price to earnings ratio of 32, which is 59% above the market average, suggesting that even after the fall in prices since the beginning of the year, the market is still overvalued. But it's not like we didn't know this was coming. Back in January, Jeremy Grantham from GMO published an article explaining how, in his opinion, the market was in a super bubble, the fourth of the last 100 years. His rationale was threefold: ludicrous price acceleration of market indices following the March 2020 collapse, the recent underperformance of speculative investments like ARK ETFs, which is comparable to what happened in both the Great Recession and the dot-com bubble, and finally, investor behavior. People throwing money at meme stocks, SPACs, cryptos, NFTs without as much as a second thought. Back in January, over 1 in 3 stocks in the NASDAQ were down 50% or more from their 1-year highs. Imagine what that figure is now. But how did we even get to this point? The short answer: central banks. Global central banks have propped up the stock market for the last 2 years, keeping interest rates at near zero and pumping trillions of dollars into the economy via quantitative easing. But now, as we're feeling the consequences of those actions, with inflation running at 40-year highs and as central banks quickly withdraw their support, we're starting to see the impact on stock prices. All of this comes back to valuations. The reality is that stocks don't always go up. Benjamin Graham once wrote that the more enthusiastic the public grows about a stock and the faster its price increases as compared to the actual growth of its earnings, the riskier a proposition it becomes. Therein lies the reality facing the stock market today. Stock prices, specifically technology stock prices, have accelerated so much in the last 2 years that they now reflect a totally unrealistic expectation for future company earnings, especially in light of our current economic situation. 2 factors are at play here. Number 1, interest rates are rising. The Federal Reserve's decision to increase interest rates in order to combat inflation has resulted in a fall in stock prices. And that's because higher risk-free rates on bonds causes future company cash flows to be discounted more heavily, thereby reducing stock prices. Number 2, future earnings themselves are far from certain. The unprecedented demand for goods, which we've seen since March 2020, is going to fade as rates rise. And with uncertainties like the war in Ukraine and the supply supply chain crisis stemming from China, companies are starting to face the realities of the impact that this will have on earnings. So when you've all these negative factors weighing down on a stock market that has been running wild for 2 years, it's clear why prices are falling. All of these same factors and more are also impacting the crypto market. Bitcoin has fallen to its lowest price since July 2021. In fact, the total value of the crypto market as a whole is sitting at around $1.2 trillion, far from its peak of $3 trillion. Investors are exiting risky investments like cryptocurrencies in favor of safe havens like cash or government bonds. The issue with crypto is that it's a non-productive asset. It's not like stock market investing where you're investing in a living, breathing corporate entity that generates cash flow. Crypto currently is how it always will be, and so your investment thesis is totally reliant on someone paying a higher price for your crypto than you did. This is why Warren Buffett doesn't believe in crypto, and it's also why crypto prices are so volatile. There is no reliable way to value cryptocurrencies as there is for stocks, and so their valuations are entirely dependent on market sentiment, and currently that sentiment is sour. Things aren't being helped by the Terra situation. TerraUSD, or UST for short, is a stable coin which aims to be pegged to the US dollar. Stablecoins are designed to maintain a stable value relative to another currency. However, with crypto markets being as volatile as they are currently, UST fell significantly from its target value of $1. This has called into question not only the future of algorithmic stablecoins like UST, but also the price stability of the crypto market as a whole. In November last year, the President's Working Group on Financial Markets published a report on stablecoins, where they found multiple risk factors, including market integrity, investor protection, fraud, market manipulation, insider trading, lack of price transparency, money laundering, terrorist financing, and prudential concerns. The situation with UST further validates the argument that stablecoin issuers and wallet providers should be regulated and subject to federal supervision. Meanwhile, Luna, the sister coin to UST, has lost almost 100% of its value in a matter of days. Where crypto goes next in the midst of all of this is anyone's guess. Then we have real estate. US house prices went up by over 20% between March 2021 and March 2022. Unlike the housing bubble of 2006, the issue today is supply. The number of homes for sale in the US recently hit 20-year lows. Naturally, when the demand for houses is far in excess of supply, prices increase. However, things could be about to change. 30-year fixed rate mortgages in the US are at 5.3%, a level not seen since 2009. This is a byproduct of the Federal Reserve increasing interest rates. When mortgage rates increase, that means the cost of borrowing money has gone up. This makes buying a home less affordable than it once was, meaning home buyers on lower incomes are priced out of the market. The effect of this is more housing supply to choose from, which in theory can slow price growth. However, the effect of rising rates on house prices is being lessened by the extreme supply shortage. The supply shortage isn't helped by the fact that it's still becoming increasingly expensive to build homes. Buildings cost inflation not only slows down residential construction, but it also translates into higher house prices for home buyers. In fact, the backlog of residential properties approved for construction but not yet started in the US hit an all-time high in February. So while it's likely that house prices will come down in the future, ultimately the rate at which they come down is a function of supply, the cost of building, and the cost of borrowing. So if we were to take a macro view as to why the everything bubble is popping, we could summarize it as follows. Global central banks responded to the pandemic by propping up the economy with very cheap liquidity, stemming from rock bottom interest rates and low bond deals from quantitative easing. All of this cheap money flooded the stock market, the crypto market, the real estate market, pretty much anywhere that the investor could make money. This naturally caused valuations to increase, and in the case of stocks, increase at a rate faster than earnings. However, global supply chains, which were slowed by the effects of the pandemic, were met with an unprecedented demand for goods by consumers. This led to mass shortages of supply, which subsequently led to the price of goods increasing, aka inflation. In order to control inflation, central banks are now increasing interest rates. This has the effect of making it more expensive to borrow money, therefore reducing the amount of money circulating in the economy economy. This reduces the demand for goods and alleviates some of the pressure on prices. Rising interest rates historically spell bad news for riskier assets like growth stocks and cryptocurrencies. In the case of growth stocks, future company cash flows are discounted more heavily due to higher rates, leading to a fall in stock prices. Moreover, lower demand and increased borrowing costs calls into question the certainty of those future cash flows in the first place, again impacting stock prices. In the case of cryptos, being non-productive assets, when market sentiment is negative, they're in for a tough ride. Hence why these assets are experiencing such intense downwards pressure. Ultimately, what we're experiencing now is the natural ebb and flow of the markets and the economy. The extent to which we're experiencing that ebb and flow is a byproduct of our behavior as investors over the past 2 years. Let me know what your thoughts are on the stock market and crypto market crash. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.